Hello everyone, this is John Kosar from Asbury Research and Asbury Investment Management, and this is your Daily 5. These are my 5 most important charts and data series that we are watching this week. Number 1, what we call the game board. Know your levels in SPX. The market's been chopping around sideways for the past few weeks, so it's especially important now to know where your levels are. So we understand the market typically moves from station to station. That is, if it breaks this resistance level and some of the market internals are supportive of more strength, we know where that level is, and we could do a little risk reward in our trading, in our investing, by knowing where these levels are at. So the chart here shows that at the end of September, we came right down to 32.33 here in green. That's the June 8 high. And it really sat on this level for that entire week. And then it started to move higher, struggled a bit to get over the 50-day moving average in blue. It's currently at 33.72. That's what many investors, a lot of people in the financial media, look as being a representation of what the minor trend is. So we're starting to get up above 33.72 now. We've been up above it now for the past, counting today, which isn't over, the past 4 days. So we're looking at this as the possible resumption of that trend and of the larger trend higher that began in June when the S&P 500 got back above the 200-day moving average, which is here in orange. So on the top side, what we're looking for is 33.94 here in red. That's the peak from February 19th. The market has a memory, and that's a level that we still think has some significance. And then the other level you can't see as well here because there's a lot of activity on this chart that I've prepared. 34.48. 34.48 is 61.8% back from the entire move down from the Sept 2 high. According to retracement theory, that would be the highest that the September 24th recovery could go if it was just a bounce in a move down that wasn't finished yet. So that's a big level to us. If we get through 33.94, that should open the door for us to go back and retest those September 2nd highs. Number 2 is market internals. Whenever we do these, we like to show the Asbury 6. The Asbury 6 is one of our tactical models that we use to show our clients on a daily basis what's happening under the hood of the market, what's the condition of the market. This is updated every day on our website, and we do that because the day-to-day volatility in the stock market makes it a lot more difficult just to look at, say, the S&P 500 and be able to get a clear look at what's happening in the market. It could be up 50 today and down 50 tomorrow. A lot of the algorithmic trading has taken over, in my view, a lot of the kind of very near-term day-to-day activities. So we like to look beyond price to see what the condition of the market is. It's kind of like taking the market's vitals every day if you're thinking of a doctor and a patient. The only one of these, by the way, that is relative to price only is the rate of change in the S&P 500. That's the top one here. You can see that just turned back to positive as of 10/7, which was yesterday. We have relative performance of stocks and high-yield bonds is another one. Investor asset flows in the SPDR, which is the ETF that tracks the S&P 500, of course. Corporate bond spreads. We like to look at high-yield corporate bond spreads. trading volume in the S&P 500, and market breadth, NYSE market breadth. So you can see they're all back to positive. They had been negative as of September 17th. So that tells us right now the vitals look good. The market is healthy. It's kind of clicking on all 6 cylinders. Asset flows drive price. Watch big cap tech. I'm a big believer in watching money moving in and out of the market because that's one of the only things that I've ever come across that actually leads price. When I was a trader in the pits at the CME in the 80s and 90s, we looked at futures open interest. What I have found is a good surrogate for that in the equity space is ETF asset flow. So what we're going to show you today is the total net assets in the Qs. QQQ, of course, is the ETF that tracks the NDX, the NASDAQ 100, which is big cap tech. I actually talked about this the last time I did a Your Daily 5, which is 3 to 4 weeks ago. So this is kind of a follow-up on that. You can see since March 26th, the Qs, total net assets in the Qs have been up above their 21-day moving average. Why 21-day? That is Asbury Research's tactical time period. When we look at tactical metrics, and this is one of ours, we want to look at them through the same lens. So whenever we're looking at something tactical, it's always 21 days or 1 business month. So you can see since March 26th to September 4th, these assets have been up above their 21-day moving average to indicate a trend of monthly expansion. That trend stalled, ended, whatever we want to call it, from September 7th all the way to September 25th, which corresponded with all this weakness when we were wondering if we were going to start another corrective period. But the S&P stopped at 32.33, that support level I showed you a couple of slides back. And since then, as of September the 28th, we are now in monthly expansion again. This is bullish. As long as there is money going into the Qs, we have monthly expansion. In our view, here at Asbury Research, that is tactically positive for the stock market. That's especially true this year because the market has been led this year for the most part by big cap tech. Number 4, we're going to look at another measure of market breadth. This is a different one than we used for the Asbury 6. It's a little bigger picture, I think, but we're looking at a late September recovery in market breadth. This is NYSE market breadth again here on the bottom, but this is the percentage of NYSE composite stocks that are trading above their 40-day moving average. This chart goes back to about mid-2018, and what it shows is when 33% or less of these NYSE stocks were above their 40-day moving average, we had market bottoms. We had one in December 2018. We had another one in June 2019, August 2019, March 20th here, 3 days before the bottom in the S&P 500. And then we had another one in September 24th. And if you look at the line going up, it looks like we're only about halfway to strong extremes in breadth, excessive strength in breadth, let's call it, up about 69%. We're only about halfway there. That suggests to me from a breadth standpoint, there is more room for improvement in the stock market and maybe more room for the S&P to go back and retest its all-time high that we made on September 2nd. Finally, we're in a really significant period in terms of seasonality. Last time I was on here, again, about 3 to 4 weeks ago, we talked about seasonality in the S&P 500. Said September was by far the seasonally weakest month based on data going back to 1957. And there was also the most frequency of having a negative close in September. That's what the red line signifies here. But here you see October gets better. October is the 6th best, seasonally best or seasonally strongest month in the S&P 500. Then we go into November and December. That's your 2nd and 3rd strongest. And then you have your 4th strongest in January. So I also look at shorter term seasonality charts that look at the quarter instead of the year. And October can be rocky. Most of the weakness of the fourth quarter comes during October, as this bigger chart shows. But the point is, it looks like, at least from a seasonality standpoint, we're starting to come out of the woods. And then if you include the positive Asbury 6, improving breadth, holding support, getting back up above the 50-day moving average in the S&P 500, expanding assets in the Qs, that shapes up right now. Again, we're in a tricky situation here. We have a lot of external issues, COVID, the election, the litany of them. But the way things stand right now, the market is getting stronger internally, and it looks like we could be setting up for a decent fourth quarter. So there's your daily 5. Thanks for watching.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.